Thanks for all the emails, the calls, the tweets. Time for top picks. What does David like now? You like Rio Tinto. Hinted at this one earlier.
Yeah, so when you look at economic surprise data, the number of economic indicators that are coming in ahead of expectation, recently over the last few weeks, the U.S. economic surprise data started to improve. We've seen lots of great economic reports around the world over the last few weeks. Japan growing at north of 4% for the first time in 20 years. Europe growing nicely. We want to have exposure to that. And the basic materials area is an area that was out of favor really since 2011. Rio Tinto is one of the biggest producers of copper and iron ore and met coal and other commodities around the world, geographically well diversified. They do not hedge their production, so if prices go up, they benefit. It's a company that's been really prudently managed. They're highly profitable. They have almost no debt, and they pay out 40 to 60% of their cash flow to investors. So if you just look, the return on their equity is about 10%, which is really attractive. And their cost to produce iron ore, for instance, $14, currently selling at $70 a ton. So this is just a way to get blanket exposure to the basic materials space to participate in the rebound of global growth.
Street's definitely on the side of buying this one as well. They got 19 buys in place, 6 of them strong buys with 3 holds and 5 sells. That was Rio Tinto. The next one, Fortive Corp. What do you like about this?
Yeah. So staying with the economically sensitive theme, you know, we've stayed away from utilities and consumer staples and telcos. I want to own economically sensitive. I talked about the Internet of Things and industrials. The U.S. Stock of capital equipment is the oldest it's been in history, and it's getting replaced. Fortive is a spin-out that came out of Danaher. It's a $22 billion industrial company. Their products are in 3 basic spaces: software and hardware for industrial sensors, telematics hardware and software for transportation, so tracking transportation equipment, and tools and components for automation of manufacturing. So this is all pretty attractive if we think that there could be some spending on automation. Company pays a small dividend, but it's been growing very rapidly, and this is just a way to participate in a resurgence in the U.S. industrial economy. 50% of the revenue comes out of the U.S.
All right, your last pick is one you hinted at earlier as well, ETrade Financial, ETFC.
Yeah, so we've talked about asset managers, we've talked about banks. We want to benefit from a couple of things: a long-term bull market in equities we want to participate in, and we want to benefit as we think that rates will slowly go higher over the next number of years. So ETrade, 35-year-old company, one of the first discount brokers. It has a very strong brand in the U.S. Because the U.S. investor is becoming re-engaged, their growth rate has really picked up over the last year. So they have grown their brokerage accounts by 5.7%. Their trading revenues are up 27% so far this year versus last year. And so they're benefiting from that re-engagement of the U.S. investor. Second, they got $50 billion in daily deposits that they hold on to, and as rates go higher, they make a higher and higher profit margin on that. So that's a positive. And then the outlier is this is a consolidating industry. You know, so we've seen a number of acquisitions in the space.
Are they a buyer or are they
I think that they would be a target.
A target.
So there's the potential for them to be bought. And in that industry, it's all about having low costs. And you put 2 of them together, you cut out a bunch of costs. So I think ETrade looks quite attractive. Stock's behaving well. It's a sector that we really like.
Yeah, we have less than a minute left, but you said something about halfway through the show caught my attention. In this market, you want to be an active, not a passive investor.
Yeah, we have a tendency to look backwards, right? And for many years, active managers weren't beating benchmarks. And interestingly, now that everyone's decided that passive investing is the way to go, own everything, there's actually very clear, defined leadership in this market. Certain sectors doing great and certain sectors doing really poorly. Like, take a look at energy, what's happening there. And so with low correlations, the opportunity to add return is great. The second piece is that there will still be pullbacks. And I think a lot of passive investors expect the passive investment to protect them, and an active manager can do something to raise cash. Like, we have hedges in our portfolios, currently some cash. I think that the swing is back to active management.
All right, great having you here, David. Great thoughts. That's it for this edition of Market Call. Stay tuned for more here on the Business News Network.